New official inflation numbers out this morning show the headline consumer price index, better known as the CPI, dropped by 0.1 percentage point last month. On an annualized basis, the official measure of inflation was higher by 6.5%, which was the expected result in consensus surveys, and down from 7.1% in November. In the days leading up to this morning's numbers, the rumor had been that inflation would actually drop a bit more than was expected. And so Bitcoin actually did pull back a bit initially when the predicted number came in. I gave mainstream economists a lot of flack because they're wrong almost all of the time, but the consensus actually did get this one right. Digging in just a bit, while goods inflation tumbled to its lowest level since February of 2021, services inflation actually soared to its highest since September of 1982. So a big number there again. Energy was the biggest driver of the decline. Energy prices are going down relative to where they had been, or at least the rate of increase of energy prices is going down, while food and shelter continued to rise pretty significantly. It's worth noting that official measures of inflation are on the way down, but these numbers are calculated differently than they were in the 1980s, which is the last time that we had such rapid increases in the prices of things that we need to live. Luckily, economist John Williams over at shadowstats.com continues to run the numbers through something close to the original methodology that was used in the 1980s, viewed through the lens, which you can see on that chart to the side of me here, of the 1980s numbers. We're dropping below the 15% mark in this morning's report, which not great news in absolute terms, but hey, I will be really happy to be back below 15% with all these massage statistics. Let's see. Will, I'll kick it over to you. What do you think here?
Yeah, I was just bringing it back into the crypto corner here. Inflation has been a strong reason to buy into Bitcoin, or a big thesis people have pulled out over the years. You need to buy Bitcoin in order to protect yourself against the eventual inflation away of the US dollar. And that sort of thesis broke really hard this last year when we saw the Fed increase interest rates, and then everything started tumbling downhill. Tech stocks, Bitcoin, value stocks, those sort of things. And if we're looking at the larger market right now, we're looking at the federal funds rate going up towards 5%, and we're all wondering how that's going to affect Bitcoin's price. And the federal fund rate is going up towards 5% because they're trying to get inflation below their official estimates. They want to get back towards 2% or even less, I think. And right now, that 6% level is pretty awful. So what I'm looking at when I'm looking at like Bitcoin prices, seeing if this is going to move at all. Last night we had a nice little pump, which was cool to see. But I think it's just going to be pretty choppy for a while. Maybe just give like a little windy price corner talk here for a second. The one thing I want to compare it to is gold, right? So like a lot of investors look at gold, they look at inflation and think those two things should trade together. And gold did rise on this news a little bit, as did Bitcoin, which is cool to see those things move in tandem. So I think just like trotting it out to like a larger perspective, or maybe a larger thesis, is maybe gold and Bitcoin's time is now over the next few years instead of over the last 2 years. Over the last 2 years, Bitcoin really traded like a tech stock. And maybe with actual inflation occurring in the United States, actual inflation that seems to be fairly persistent, Bitcoin might actually have like a tenable claim to that thesis if it can continue to itch up as inflation holds. Jen, I want to throw a topic over to you though.
Yeah, well, I'm just full of questions when it comes to the economy. So Adam, can you paint a picture for me, right? So does this mean that interest rates are going to decrease? And in my head, I'm like, okay, interest rates decrease. That means it's better for risky assets like crypto, like tech stocks. But with the recession looming, does any of this actually matter?
Yeah, I think that really is a good question. That's like the question that's kind of key to all of this stuff. When we talk about kind of inflation and we talk about risk assets, really what we're talking about here is when will the Federal Reserve in the US and central banks around the world return towards very, very low, artificially low costs to borrow money. At the point that they do that, that's when you see risk asset markets really take off. Because otherwise, like right now, the comparison is, well, I could have my money in stocks, or I could be earning 5% lending money to the government. That 5% lending money to the government is a pretty safe bet. There are definitely concerns, and Bitcoin and gold too. Also, both are essentially like they're like extreme situation assets in practice. Inflation is not really a good way to think about it. It's not about day-to-day inflation. It's about systemic risk to the dollar system itself. So when we get readings like this, what that then suggests to markets is that, oh, hey, the worst is going to be over. Markets are in what's known as forward-looking pricing mechanisms. Traders look into the future to figure out what they think prices will be, at some point that's not today. And then they, buy up prices, or they bid up prices, or they bid down prices based on what they think the future holds. So what's happened over the course of the last couple of, at this point, like 7 or 8 months, is that the only thing that matters is the Federal Reserve. The only thing that matters is when will the Federal Reserve either face so much political pressure that it has to pull back on these rate hikes. And it's worth noting that the rate at the start of this process was 0.25%, and we're now up over 4%. So that represents something like a 1,400% increase in the cost of money just in the last year, which is wild and unprecedented in any sort of example that you can think of historically. So I think that we are still at the whim of Fed Chair Jerome Powell. Whatever he says matters much more than anything in reality. And really, it's all a question of when will they give up and return to the easy monetary policy that they will ultimately need to continue to power the government without it going insolvent, basically. So it's a real cheery topic. Hope I provided some clarity for you there. Zach, what do you think?
I got nothing. When will they give up? Is there anything in the tea leaves indicating that they will reverse course? I'm going to throw it to you,
Wall Street
Adam.
thinks they'll give up later this year. Yeah,
later
the
this
consensus.
year.
The consensus is basically later this year. The Fed has been saying very clearly, we're definitely not giving up this year. It's probably mid next year, something like that, mid 2024. Markets don't believe them, and that's one of the reasons why they have to continue to have this kind of mixed messaging where they're like, hey, things are getting better, but also they're bad and they'll be bad for a long time. So just expect that. That's what they want markets to do, because to the extent that markets aren't getting that messaging, markets go up because they don't believe the Fed. So it's a weird situation. Like I said, markets aren't supposed to work like this, but hey, that's the modern US dollar economy for you.